Welcome to the Executive Real Estate Investing Show. This podcast is for you, the busy business owner or executive looking to create generational wealth. Here, we're going to show you how to do that through real estate investing, from multifamily to industrial and everything in between. You will become a real estate investing expert. And now, here's your host, Michael Holman.
Welcome to another episode of the Executive Real Estate Investing Show. I am Michael Holman. I am your host, and buckle up because today we are having our very first Ask Me Anything. So we're going to be doing these probably, every few weeks, maybe like once a month. And this is your opportunity to just ask me any question you want. This is completely unfiltered, right? There's no set responses. You are getting the raw answers directly from me on the questions that you have submitted to us. So excited to be doing this, excited to start answering your questions. We have actually gotten a lot of questions already today, and so we are going to keep them coming. You can, if you have a question that you want to ask, go ahead and go onto our website, www.executivereishow.com. All right, and you can go ahead and ask us the question, the executive questions, okay? So this is, like I said, this is our very first executive questions episode. But first, as always, here's your executive tip, okay? Executive tip for today's show: understand your limitations. So one of the most important things you can understand is not only what you're good at, but understanding what you're not good at as well, okay? That is really, really important and crucial to any successful business, to any successful real estate investment strategy. If you understand your limitations, you know where to get help and you know when to ask the experts, okay? So don't be afraid to admit that you don't know something. I do this all the time, right? I develop millions and millions of dollars of real estate, right? I mean, I'm working on a project right now. It's a $65 million, 320 unit development, okay? I'm working on this, and it's in a city that I haven't worked in before, okay? So I'm not as familiar with the city and the city officials, what the city ordinances or any of the nuances, what the code is. So understanding that limitation, I went out and I hired a land use attorney to help identify those nuances, right? What are those things in the city code that keep tripping everybody up because they're unique to this city, right? And yeah, I am spending money on that. I'm spending a lot of money on that, in fact. But you know what? Experience has told us that saves us infinitely more money on the back end. Saves us months and months in the development process. It saves us tons and tons of time and investor money trying to figure things out and our time to do that. So, like I said, executive tip for today: understand your limitations. And when you have a limitation, leverage the people around you, leverage your relationships. I heard a really good quote the other day. He said, "I've never lost money from hiring the best." And I completely agree, right? I mean, 100% agree, right? A lot of times people look at these things and they don't want to hire anything out. They don't want to do anything out because they look at it and they say, "Oh, I don't want to spend the money." And it's like, you know what? I understand. I sympathize, right? I come from an accounting background. A lot of people think of me as a penny pincher, right? I don't know. And at one point, I definitely was in my life, right? But the thing to understand is when you get into these real estate investments, when you get into your business, hiring the best will always save you money in the long run. Okay, so that's the executive tip for today. A little bit of a long one, but super, super important to understand. So let's get into the executive questions. Like I said, this is completely raw. This is unfiltered. I simply sit down, I get handed a list of questions, I tell you who they're from, I tell you what the question is, and you get my response, right? This isn't prepped, this isn't scripted, this is a raw, honest response. So, first question comes from Stephanie S. Stephanie says, what's your advice for getting started in real estate investing? Stephanie, this is a fantastic question, and it is probably the most common question that I get. I get it all the time. I get it from young, old, rich, poor, everything in between. Everybody comes to me and they say, you know what, Mike? I like what you do. I like what you're a proponent of. I understand the benefits. What do you recommend? How do I get started? And there's a few things that I tell everyone. All right, so let's just start with what the most common way to get started is. The most common way is single-family homes, right? Because it's something that people know, it's something that people understand, right? They look at single-family homes. Most people have rented a single-family home or lived in a single-family home or they grew up in a single-family home. So that is by far the most common way to get started, right? And there's multiple ways to do a single-family rental as your first property. Whenever anybody who's coming like right out of college starts talking to me, there is a myriad of ways to get into real estate investing, even right out of college, right? You don't have a lot of money. Maybe you're trying to save up to buy your first house or do something like that. I highly recommend when you're young, look for ways to potentially house hack. Whether you're on your first house or your second house, look for ways that you can house hack. I mean, if you're young, a lot of times maybe you're single or you're not married or living with someone, right? You have a little more freedom. You have a little more ability to move around, right? One of the best things that you can do is maybe you buy a single family home, you rent out the basement, or you rent out some rooms, or you buy a duplex or a triplex, depending on your situation, right? There are literally thousands of stories that I can reiterate to you where people have done this, right? There are even more people who have used this strategy as the catalyst to get into real estate investing, right? They buy a house, they rent out the basement, and then when they move out of that house, right? Maybe you're single, you buy a single family house, you rent the basement, you get married, and your significant other comes in and says, I really don't want to live in, maybe this rundown place where there's strangers living in the basement. Well, that's great, right? Then when you move, you keep that house. Now you're renting out both the basement and the upstairs, and you move into another house. You have officially created your very first real estate investment. And you know what? You can do that with very little cash. There's a lot of ways to do this, but you can do this with hardly any cash. You can do down payments down to 5% on conventional loans. You can do down to 3.5% on some of these first-time home buyer loans or FHA loans, right? There's VA loans if you're a veteran. There are a lot of options here. You want to know the ultimate secret to all of this? If you have your real estate license or you get your real estate license, you can then get a commission when you purchase the house and use that to lower your down payment even more. The first home I ever bought was a townhome. If I remember right, the purchase price was like $250,000. I was going to put 5% down, so that was $12,500. I was a real estate agent. I had my real estate license. I wasn't an active real estate agent. I was actually working at Ernst & Young, one of the big four accounting firms at the time. But in college, I got my real estate license, and I represented myself as the buyer, and I got 3% commission, right? Let me do the math right now. I should have the math. Everyone's all like, oh, you're an accountant, you're good at math. Guess what? I use a calculator. So I'm using calculator right now, right? So on my $250,000 home, I got roughly a $7,500 commission. Now that $12,500 that I had to put down, I put my commission of $7,500 to that. I bought my first home for $5,000. I got a great loan. I got a great property, right? So being able to do that and find ways to house hack, right? People are doing this all the time too with duplexes or triplexes. And depending on your situation, where you live, right? Those are easier or harder to find. They might make sense or they might not, right? But analyzing these are potential options if you're just getting started in real estate. And they're great options. I have a brother-in-law who just did this. And to be honest, it's a great idea, right? I mean, he's doing it all the time. I see hundreds of people doing this all the time, right? But he bought a house, he fixed it up, he's renting out the basement, and he's doing great. That is a fantastic way to get started if you're looking just how to get started, right? Now, there's a couple of caveats with that, right? You gotta have okay credit. You gotta have the money to at least close on the initial down payment, right? So I'm not saying that you can have a credit score of 400 and have absolutely no money in the bank and $50,000 in consumer debt and you're going to be able to go out and do this. I'm not saying that. So it does take a little work and a little effort, right? But if you can save up $5,000, $10,000, $15,000, which I firmly believe if you were being very intentional about it, you can do that, and you cultivate a decent credit score, you can go out and get a great loan. And when you do this, get a 30-year loan. Some people are huge proponents of 15-year loans. And you know, I get it. I disagree, but I get where they're coming from. But, you know, for the average person, if you're looking to get invested in real estate, do a 30-year loan. Take advantage of that leverage. Leverage is a great way to get into real estate investing. It lets you buy things that you couldn't buy normally. And there's a lot of positive benefits to leverage. We're not going to get into that today because that's not the question. But so if you're young or you're looking to get started, maybe you're not even young, right? I have seen people do this into their 20s, 30s, 40s, all the way up to their 60s or 70s, right? Whatever you have to do to get started, that is what you have to do, right? If maybe you're an empty nester at this point and you're saying, I've been through everything, but maybe I didn't come out of retirement as well off as I wanted to, so I need to kick it into high gear, and you're willing and able to move around, go buy a single family, go buy duplex or triplex, right? This is a great strategy. One of the best ways to get started is this house hacking technique, right? In this show, we're specifically speaking and talking to business owners and business executives, right? I mean, maybe you're a business owner, maybe you're a business executive, super busy, you're trying to get started in real estate. I mean, can you house hack? Yeah, but you're probably less likely to do that. I mean, if you're established in your career, right? Things are good. You got a little extra cash. You're probably not looking to go and move around a bunch or go buy a single family home and rent out all the other rooms to a bunch of people, that you don't really know. So I get that. If you're looking to get started, once again, single family homes are the most common. I mean, people understand them, right? And there's a lot of opportunities that you can get great loans with them, right? Because you're getting government subsidized loans with a single family home. Anything 4 units and under, you're getting the best rates you can get. There's some negative things, don't get me wrong, to this, but it's a great way to get started. People understand them. There's a lot of real estate agents who understand single family homes. There's a lot of property management companies who understand single family homes. So single family homes, great way to get started, most common. If it were me, I might skip the single family homes. One of the things that I would look at, so that you can be a little more passive and take advantage of some economies of scale. If I were just getting started in real estate investing and I was established in my career and I had a little extra money, I'd look at syndications, right? I would look for a sponsor. I'd go out there and I'd do some research, start asking around, start vetting some people. I'd look for a real estate investment sponsor who puts together syndications. And I would go be a limited partner in one of those. You can get into those for $50,000, $100,000 minimum investments, sometimes as low as $10,000 or $25,000, even depending on the investment and the sponsor. And you can go invest in these. And these things, I'm not going to speak for everybody. And honestly, this is just informational. But a lot of times these investments can kick off 10, 15, 20 plus percent, in annual returns. So you can get and you're getting all the benefits of directly investing in real estate. You are getting the benefits, the tax benefits. You're getting the cash flow benefits, right? You're getting all the benefits of directly investing in real estate. Let me tell you what I wouldn't do. I wouldn't go investing in a stock that invests in real estate. All right. If you want my opinion, that's not investing in real estate. And I have a lot of financial planners that would that would argue me to the death. But you know what? You don't get the same tax benefits. You don't get the same cash return. You don't get the same opportunity to create value in that investment that you do in a direct real estate investment. So I wouldn't do that. Just my honest opinion. Like I said, some people are going to be mad at me for saying that, but I wouldn't do it. To me, that's not real estate investing. That's stock investing, right? And I think the two are very different. Okay, Stephanie, great question. We kind of beat it to death, but absolutely fantastic question. Like I said, one of the most common questions that I get. So let's move on. Next question is from Reed S. Reed says, what are your thoughts on effects to future multifamily property valuations due to the current political trend to establish additional rent controls in some communities? Wow, Reed, that's a pretty intense question, right? And fairly advanced. So I won't get into too many details here. But Reed, I agree. I mean, rent control definitely has an effect on the valuation, right? No matter what you do, your valuation is established by taking your income minus your operating expenses and getting to your net operating income. Your entire valuation is based off of that number. If that number is artificially low because you have rent control that's been established, that is something you're going to have to deal with, right? And you need to be aware of this. I'm not going to get into any, advice or techniques or trying to get around rent control. I'm not getting into any of that right now because I want to keep it pretty basic for everybody. The thing that I would just say is, if you're looking at investing in certain areas that have rent control, that's one of the things you need to be aware of and understand. You need to understand if an area you want to invest in has rent control. And if it does, what is it? And what are the laws surrounding it? I'd highly recommend, if you have rent control regulations in a place you want to invest in real estate in, hire an attorney. Let them help guide you through that process, right? I personally you want my opinion? I don't like to invest in places that have rent control. And so I just avoid it altogether, right? I mean, that is a big enough deal to me. I take my development and my investments, other places that don't have rent control. But that's just me, right? There's plenty of other people and companies that invest in areas that have rent control and that do well, but you have to be able to navigate it, right? If you can't navigate the rent control, then you're going to find yourself kind of in an upside down situation. So that's my general answer. I have a lot of thoughts on rent control. I'm not going to get into any political aspects in this show right now, right? I have a lot of thoughts on rent control, but I mean, that being said, you just have to understand it, right? If you have potential rent control in an area, you just need all the information surrounding what that actually means for you as a real estate investor. That's super, super important. Okay, next question. Next question comes from Lou D. Lou asks, since it's always location, 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 where are you looking and developing? Lou, great question. First off, I'm going to say go listen to the last show that we talked about markets, right? I think it was show 2. We talked about markets. Go back, listen to that episode dealing entirely with markets, right? An entire 20, 30-minute show specifically on where markets currently are, painting a broad picture, and yes, even where I'm looking. So where I'm looking, I'll just be perfectly straightforward and honest, I am currently developing and investing in Utah and Arizona. Those are my two main markets. I have investments all across the Midwest, but Utah and Arizona are the main markets that I'm looking at, and that's for a myriad of reasons, right? I like the growth, I like the economic growth, the low unemployment rates, and I like the jobs that are steadily being created in the area, which for me as a multifamily developer, that's really important, right? I need population growth. I need I need jobs to be created so more people want to come into areas and live in areas, right? I mean, that helps my value go up. Specifically right now, I'm looking in Utah and Arizona as of this show. That doesn't mean I'm not or won't invest in other areas. Like I said, we've done investments in across the entire Midwest and West of the United States. If you go all the way back, we've even gone all the way east. Right now, we have assets in Utah, Arizona, Colorado, Wyoming, Montana, South Dakota. We've done stuff in Oregon. We've done stuff in Texas. We've done stuff in Tennessee. Right, so we've been all over the place. But right now, in this moment, I'm looking at Utah and Arizona for a lot of reasons. But like I said, go back to the episode where we specifically talk about markets. That is my recommendation to you. Henry Y asks, do you see construction costs coming down? Whew, that is a question, Henry. And I wish that I had a crystal ball and could give you a perfect 100% correct answer. The honest to goodness truth is I have no clue what construction costs are going to do. What I will say, construction costs historically, they're very cyclical, right? So at the time of the show, we're dealing with absolutely astronomical record high prices in lumber, for example, right? Lumber is just off the charts expensive. Does that mean it's going to go down? Does that mean it's going to keep going up? Like I said, the answer is I don't know. But the important thing to understand is construction costs are often cyclical, right? We're in a booming time. We've been around and recently been through a global pandemic, which put pressure on some of the supply chains, right? I mean, there's a lot of reasons why construction materials specifically would be really high, right? On top of all that, we have this booming market, right? There's a lot of people developing. There's a lot of people constructing stuff. And so subcontractors, the people who are actually doing the construction work, are pushing prices up because they can. They have so much work that they continually are pushing up prices because they can, right? I mean, if you're so busy that you can't do all the work that you have assigned to you, the natural way to reduce the amount of work to a reasonable amount is increase your price till people stop paying. So I don't blame those people at all, right? I mean, any one of us would do the same in that situation. So I don't know. They're cyclical. A lot of times you'll see lumber or steel. It'll tick up in Q4 and Q1 and come down Q2 and Q3. I'm not saying that's what's going to happen now, but it's very cyclical. I mean, the more important than focusing in on the construction cost. As all of you know, I've said it 100 times. I'm a developer. That's what I do. I like to develop new assets, ground up development. So I deal with construction and construction costs all the time. I mean, that's my biggest factor on a lot of my developments. But the important thing to know is whether construction costs are high or construction costs are low, there's always investments and opportunities to be had, right? If construction costs are really high, that oftentimes that means rents are high as well. I'm not saying every project's going to work out, but it's important to know that because then you can account for the construction costs, right? Maybe you start being a little more selective, in where you're going to build or what you're going to build. So even with high construction costs, I firmly believe there's a lot of opportunity. Is it going to come down? I don't know. Like I said, it's a very cyclical business. It goes up, it goes down. When times are good, it goes way up. When times are bad, it goes way down. I don't have the faintest idea, and I'll be perfectly honest about that. But I think there's still deals to be had. Okay, we're going to get into our very last executive question here. And this last question comes from Diana H. Diana asks, my clients want to invest in real estate through their self-directed IRA. I have some clients that have done this, purchasing existing storage units, but do you also see this as a build and sell strategy? Do you believe the return is better on a build and sell rather than a buy and hold? Great question, Diana, and there is a lot of questions within that question, so we're going to go ahead and break it down a little bit, okay? First off, sounds like you're already in maybe the real estate business or IRA business. Congratulations. I hope things are going well for you, Diana. since you have clients that are looking to use their self-directed IRAs. First point, using a self-directed IRA to invest in real estate, awesome. Great idea. Especially and specifically if it's a Roth IRA. I highly, highly recommend investing in real estate using a self-directed retirement account. Roth IRAs, by and large, best way to do it, right? If you have a self-directed Roth IRA account, you should be investing in real estate in some form or fashion, whether that's into, single family homes, duplexes, triplexes, your own apartments, or a syndication. Use your Roth IRA to invest in real estate. It'll exponentially increase your returns, okay? Get that out of the way. The one thing to note on that, right, if you're using a traditional self-directed retirement account, there are certain things that you need to be aware of, right? And we're not going to get into those here, but you are going to have potentially UBIT taxes, and so you need to be aware of that, right? I'm not saying don't invest. I'm just saying be aware. Getting into the next parts of these questions, talking about self-storage, it looks like specifically we do a lot of self-storage, and I've done a lot of self-storage personally. Do you see this as a build and sell strategy? So absolutely. I don't necessarily think that one strategy is inherently better. Well, I take that back. I take the position, I think development, nothing is better on planet Earth to me than development. I absolutely love it. I'm obsessed with it. I think about it. I dream about it, right? So yes, I do think development is the best way to go, but I'm not saying it's the best way to go for everyone. But absolutely, I mean, if you have a self-directed retirement account and you're looking to invest in real estate, investing into a ground-up development is absolutely an opportunity, right? Whether you do it yourself, whether you go with a sponsor who's doing it, there's a myriad of ways to make that happen, but absolutely, you can 100%, you can invest in a brand new ground up development, whether it's self-storage or anything else, any other asset, you can invest in a ground up development using your self-directed retirement account. And I'd highly recommend it. I think it's a fantastic idea. As far as developing or build and sell being inherently better than buy and hold, that is totally up to the goals of the investor. I don't think I can inherently say one is like I said, I think one is better than the other, but that's for me personally. Collectively, as a real estate investing strategy, is one better than the other? What are your goals? What are you trying to do? Build and sell, I mean, it works for me quite well, right? I don't sell everything. I build and I hold some things, right? And I think there's a lot of merit and value to that. And, our strategy kind of continues to evolve. We're actually evolving more and more towards building and holding rather than building and selling. There's benefits to that. I mean, the pros of that, you generally have these huge value creations. You build something at one cost with the expectation that at the end, when that thing's built and stabilized, it's going to be worth, the market value of that asset is going to be worth significantly more than what you cost. So you're able to capture all of that value creation. Once you sell the asset, that's that capital event. That allows you to pull all that equity out of that asset and go use it for another development, go use it for, other real estate investing, whatever you want. There's a great strategy to that. There's a lot of merit to that strategy. But buy and hold as well, there's a lot of merit to that. In a build and sell strategy, when you invest money into that, you're likely not going to see any return for 2 or 3 years. And then you're going to see this huge return, in years 3, 4, or 5. When the asset's stabilized and sold, I mean, you get these gigantic returns, right? That often are better than the buy and hold, but that's not for everybody, right? Not everybody likes that situation. Some people just want to buy an asset. They want the cash flows, right? They want the regular cash flows. They're looking at cash flows as the most important thing, and that's fine, right? I mean, I would argue that cash flow is really important, but it's not necessarily the one and only thing to look at, right? You hear some people that are like cash flow. That's the only important thing. Nothing else matters besides cash flow. I mean, depending on how you're looking at cash flow and how they're defining cash flow, I might agree or disagree, but that's just a different strategy. I don't think it's bad. And a lot of times, some people will try and find ways to build value in that. Sometimes people just want the cash, right? I mean, you're buying a core asset. It's completely stabilized. It's brand new. You're not looking to create value. You just want cash. And if that works for you, that's what your goals are, that aligns with what you're trying to do, then great. if you were reaching, retirement, or you're well into retirement, you're over here thinking, I don't really want to wait 3 years for, this huge investment to come back to me. I really want to start seeing something now. Yeah, then development's not going to be for you, right? Buy and sell strategy isn't going to be for you. You might want to look at a buy and hold. I mean, if you're kind of in the middle of your career, you don't need the cash right now, then yeah, I would definitely look at a build and sell, because, you're likely going to come out a lot better, at the end of that investment life than you would on a buy and hold. But like I said, it's different for everybody, and it's really up to the determination of the investor to look inward and decide what it is that they really want, what they're comfortable with. And, one of the important things is who you're doing it with. Are you doing it by yourself? Are you doing it with somebody? I mean, that's a really important factor, is the people that you're surrounding yourself with in this business. So, Dan, I hope that answers your question good. That was a great question. A lot of different facets, but I think we got to all of it. All right, that is our very first Executive Questions Ask Me Anything episode. I hope you liked it. Like I said, that was completely raw. There was no scripting. There was no editing or filtering, right? There wasn't set responses. I barely saw these questions before I sat down here and recorded this. So I hope that everyone found that valuable, and we are excited to see you next time.
Thank you for listening to the Executive Real Estate Investing Show. Ready to learn more? Go to executivereishow.com for more episodes and resources to help you create generational wealth through real estate investing. That's executivereishow.com.